super end of 2023 rally. We also had some big single stock falls, or names like the widely held HDFC Bank, which feature in a lot of portfolios, names like Polycab, Z. So for a lot of investors, who got used to a one-way ride up, this can be a time of a little bit of nervousness. So what do you really do as a mutual fund investor? Do you need to change your strategy at all? And what do events like a budget coming up really mean for you? Sonal, let's find out, because these are questions that we have been getting.
And there are a lot of investors who have gotten in thinking that things could be like 2023. So it's best to tell them that that's not the case. And on that note, let's welcome Mohit Gang, who is the Chief Executive Officer at Moneyfront. Mohit, always a pleasure speaking with you. Thank you so much for joining us. And as Pavitra was mentioning, it turned out to be very different from that high note that we ended 2023 with. In times like these, when you see that market is pulling back from all-time highs, we are seeing stock-specific action as well. What do you suggest a mutual fund investor should do? What should the strategy be in times like these? Because that is something that could happen anytime.
Oh, absolutely. Thank you so much, Sonal and Pavitra. Always a pleasure. Look, so I think the year started with a whimper. People were anticipating on the back of an extremely robust 2023 that markets will continue a good rally and good momentum. But I think there were some events, there were some news flow around it, and the market was a little timid at the start of 2024. But again, we have kind of picked up some momentum in last 2-3 odd days, right? So markets will continue to operate in this fashion. Honestly, I think for investors who are extremely long-term investors, who are patient investors, who are especially mutual fund investors, right, and who are wanting to create wealth for themselves or planning for their retirements, I think for them nothing changes. Honestly, events will come and go, calendars will keep changing, and months will keep passing by. But people who are following a disciplined approach towards investing, I think that cannot pause, or that cannot take a break at any point in time. One has to continue with his or her asset allocation. If you are 50 equity, 50 debt, you cannot get overdrawn or overcommitted in a market which is extremely momentum driven, and you cannot also pull out of the market which gives you a little bit of a jerk kind of a scenario or a correction kind of a phase, right? So if you continue your asset allocation the way it has been, the way you have planned for your financial goals, there's no way you will go wrong in this entire thing. If market continues to do extremely well, you can always shave off some profit and plow it back into debt and maintain your asset allocation. And that ways you also consistently maintain the cash flow scenario of yours, right? So you're always sitting on some debt, you always have some equity to play with the momentum, provided you follow your asset allocation, right? And I think that's the only philosophy which one should stick by.
Oh, absolutely. And we've spoken about this so many times, right? That every year there will be some amount of a correction that comes through. You can't get out of the game then. But, Mohit, we often see a rush of retail to the markets when we're at all-time highs, right? Which is a little bit opposite to maybe what should be happening, just because of maybe the FOMO factor. Do you think we need to train ourselves to, every time the market offers you a correction like this, maybe put in lump sum money at those levels?
Oh, look, I think that's one trend which never ceases to die, right? As soon as you see markets going at a frenzied level or extreme amount of momentum, the retail money tends to increase, which is what should not ideally happen. I think the reverse is what you would like to see and hope for. But honestly, that doesn't happen. Every time you see momentum, people have, and as you rightly
now
said,
I cannot sit out anymore. Now I'm going to play.
It's very difficult to watch the game from the fence, right? So you all want to go out in the middle and play the game yourself, and that's what is happening also right now. Look, again, it boils down to discipline. If you have the discipline and if you keep some pockets aside, you should always have dry gunpowder. I have of the firm belief in these kind of crazy markets when the valuations are soaring, you still can't be out of the market. You have to be in the game, but you have to keep some dry gunpowder at all points in time. And whenever markets give you that opportunity, in the past 43 years of market history, there's not been a single year when you have not seen more than 10% correction in the market. You will get that opportunity, provided you have patience to last the game with some dry cash by the side. As and when market gives you that opportunity, you have to have a fixed formula. It can be any formula depending on your asset allocation. A 5% correction will mean that you put in another 5-10% of your cash which is lying idle, or you can shape the formula as per your own asset allocation and financial plans, but you need to have cash for opportune movements.
You make money slowly and then suddenly, right? From gradual it comes to sudden. But in that case, you're talking about a time where there could be correction in the market. market, or we could see some consolidation. What are some of the mistakes that investors make apart from not being patient when market corrects? And what is something that you think can be avoided? And it's easy, but investors just don't put so much effort at that point in time.
Look, I think it's one of the often quoted thing that when it is when you're getting when the markets are at a frenzied level, you need to be a little fearful, and when markets are whatever a little skeptical, you need to be more greedy. But that doesn't happen in practical life. Honestly, we've seen it time again. So one, keeping some cash, which is extremely important, as I said. Second is to follow your asset allocation to the T. If you deviate from it, and if you get tempted in the market cycles, that's when most of the investors tend to commit mistakes. They get tempted and they kind of commit themselves with huge amount of capital. Sometimes they lever themselves up. Sometimes they will raise debt, and that's the starting point of all the downfalls of many investors, right? And plus, if you have a process, which is that if you are doing some SIPs, STPs, if you have a regular flow which is getting committed into the market, there is no need for anyone to stop it, irrespective whether the market is at a crazy high or irrespective whether the market is correcting big time, right? You have to always think it of in a very basic manner. In times of corrections, you are accumulating more units. In times of bullish phases of markets, you are actually riding the wave when your value is increasing, right? So both ways, the philosophy of SIP will keep you intact. So the whole thing which investors need to avoid is to rush out at bad times and redeem when the portfolios are showing red, and we see time in and time out that investors get extremely fearful of the market corrections. With every correction, they anticipate more correction and they rush to take out money rather than putting in more money at those times. So I think those are some fixed discipline formulas which one needs to follow.
Okay, that's very helpful. I'm sure everyone can benefit by hearing that. But you know, Mohit, this past month we've seen some huge corrections in stocks, right? Names like HDFC, it's there in most portfolios, right? I mean, then you have something like a Z falling 30% in one day. Polycab, which used to be an investor favorite, right? All of those stocks. So it does create some amount of nervousness. What do you do if you find yourself exposed to these stocks via mutual funds? Because, I mean, clearly you cannot immediately exit either.
The first thing you should do is you should thank God that you are in a mutual fund, honestly, and so and you don't have the stock directly in your holdings, and that's the whole genesis of why you invest in a fund, because you are covered with a basket of 50-70 odd stocks, right? So your downfall and your upside also is capped to a level, but your downfall is kind of covered, right? When it happens with names like HDFC, and not for any other reason, but for sheer reason that the results were not in expectation with the market numbers, right? When it happens with those kind of names, you can't do anything. To be very honest, it's the largest company by market cap in the country. Every fund has it, every scheme has it. So you can't do much about it. You fall with it, you sink with it, you rise with it, right? So you have to go with the flow. There will be some smart fund managers who would have gone underweight HDFC. Doesn't mean that they don't have HDFC, right? They will not have it as per the market weight, and HDFC is almost 13% on the indices in terms of weight. So a good fund house will still have 9-10% of it. Most of them are underweight because they can't go above 10%, right? So any which ways they are underweight HDFC by default. The second part, which is when it happens with other stocks which are not available so hugely in all the schemes, and the correction happens because of some negative news flow on the stock itself or the promoters or some kind of let's say fraudulent activity, right? So that is a red flag for sure, and you need to figure out that the schemes which you are holding, are they going through such instances time in and time out? And I'll go back to the debt analogy here. In 2019, when the IL&FS crisis happened, you could have figured out 2 or 3 schemes or fund houses in the market which had IL&FS, which had SR, which had DHFL, which had Syntex, and they had all the names. Right, so, and that's a sure red flag that if you have all these kind of names which are cropping up in the same fund house or cropping up time and again with the same similar kind of schemes, then definitely there's a red flag around. So if these instances repeat too often, that you have these kind of stocks in a portfolio and they get exposed very frequently, then one has to take a cautious stand and perhaps come out of those kind of schemes. But otherwise, I think market episodes can
It's also like picking a stock, right? You have to do your research, even if it's a mutual fund, which is a basket of stocks, or a singular stock. So that takes me to the most interesting topic that people spoke about last year, that was mid and small caps. They've been doing well so far this year as well. They've not done so badly after that stellar rally. Is this time to be cautious?
Totally yes. Okay. So look, I think no amount of momentum can continue for so long, can persist for an irrational amount of time. And honestly, I think it's been overdone, the kind of stretch which we have seen in some pockets of mid and small caps, not the whole basket per se. But I think investors have to be cautious. This is abnormal return which they have actually reaped last year, some 43 odd % on mid caps and some 48 odd % on small cap indices. And I'm sure there are few active funds which have outdone these numbers as well, right? So one has to take a cautious stand, and you have to see relative value always. And relative value today is hugely available on the large cap space, on the blue chips. It gives you that cushion. If markets correct, it saves you from that extreme volatility. It gives you the benefit that it will be the capitalization which will bounce back the earliest in case of a correction. And plus the relative valuations are still quite reasonable, and lot of large cap names, lot of the banking packs, all the heavyweights, right? Reliance has just rallied last 2 days. Honestly, it hasn't done much for last 3 years or put together. And so is the case with all the large private banks or perhaps the IT pack, right? So those are yet to rally. There is a lot of value out there. Be safe, a little cautious, perhaps a little overweight on the large caps and blue chips.
Okay, got that. That is actually a voice that, an opinion that we've been getting time and again from all of our experts. So, caution is definitely warranted. But, another space which has seen a lot of momentum in terms of mutual funds has been this entire sector and thematic funds, right? We saw PSUs do well, power do well. This AI theme just completely took off as well. So, if we're talking about a year of more moderate returns and you are someone trying to generate more alpha, you're maybe willing to take some more risk, do you think this is a good kind of fund to get into?
Look, with sectoral funds, you have to be extremely cautious, and you have to read the sectoral cycles really well, and you have to be honestly capable enough to take a call when to exit. Enter is quite easy. Honestly, you see the momentum, you ride the wave, and you sail with everyone else. But just when the tide turns, it's when you will get exposed, right? And we have seen it time in and time out again. Just to give you an example, let's say pharma. From 2016 till 2019, all 4 years was negative return. And suddenly you saw 1 year, which was because of COVID, you saw huge positive returns. A lot of investors flocked into pharma by 2020 second half, and 2021 was an extremely low single digit return for pharma. And again, 2022 was a negative year, and then you again saw 2023 a little bit of a bounce back, right? So you can't just really predict these kind of cycles. PSU. Last 10 years, Pavitra, there have been 5 negative years, and negative to a large extent, like -20, -32, those kind of negative years.
Now
right?
it wants to make up for everything in 1 year.
So you have to be extremely cautious. Reality was a boomer last year, some 79 odd % return for the sector put together, right? So now again, to think on back of that kind of a performance, it'll again give you those kind of returns. You have to be extremely lucky or skillful, right? And it's a very tough combination to get, right? So my sense is, be safe in flexi cap funds. Let the professional guys do their job. Let them do the manage the cycles, let them manage the market caps for you, and I think just be safe in a flexi cap or a multi cap fund.
In 2024, if you still make that kind of money in royalty stocks, that definitely luck in a consolidated market, the kind of moves that we've seen. But Mohit, we have to get into a quick break. When we come back, we'll continue this chat because it's been an interesting one, and also we'll talk about some budget expectations. That's the big event a day after tomorrow, so we'll discuss that and a lot more. You stay tuned, we'll be right back.
Finance Minister Nirmala Sitharaman is all set to create history as she presents her 6th consecutive union budget. What will the budget mean for you and for me? Stay tuned to CNBC TV18 on our YouTube channel as we analyze the budget in real time and bring you the best analysis. Stay tuned to CNBC TV18, your budget headquarters on YouTube.
Welcome back. You're still tuned into MF Corner. We have with us Mohit Gang, and we are talking about the key expectations from budget now, after talking about how to strategize during a market fall. Now, you know, Mohit, we know it is a crucial time for the markets. We have the budget, the FOMC decision, we do have the RBI policy, all of them coming together. In a time like this, any change in investment strategy would you suggest, or do you think it is to be disciplined and continue with your strategy?
I think you've answered it. Right? So to be very honest, I think these are periodic events. Some are quarterly, some are monthly, and budget obviously is an annual event. It comes and goes every year. Obviously, those 2-3 days are significant if you are a stock trader. If you are closely following sectors, and if you're closely following some themes, or if you have thematic funds in your portfolio, let's say, right, you might want to follow government action. You might want to follow government announcements around the budget. And anyhow, I still think it's a policy statement. It also gives you directional space 1 year forward, and perhaps sometimes 5-year, 10-year forward outlook also. So one has to be extremely cautious getting into this kind of a thing. You have to be a good reader of these kind of events, but you don't have to like really panic, or you don't have to press the button of purchase or redemption either ways, right? So one has to continue to do his regular investments in the normal fashion, but you cannot like sit away from the event and just be a bystander. So.
But as a mutual fund investor, you think that you don't really need to, you know, do anything at all, and you can just continue to hold your position. There's nothing that you need to do before or after an event like this, right? Like a budget.
Not really, Pavitra. Honestly, I think there is very little that you can any which ways plan and do for these events, because no one knows what exactly is likely to come out. And these are all surprise packages. And this year, any which ways, budget is not a full-fledged budget. It's a vote on account. So obviously, you will have enough time. There are certain times when some kind of calls do happen, like the debt taxation, which happened last budget, and which can completely change the texture of your portfolio. So one has to be cognizant, one has to be aware, has to go through the fine print. But again, you can't take do a panic reaction prior to the event.
And you can't preempt such decisions, right? But generally, what is the expectation from the mutual fund industry? This would be the interim budget, but in the budget for July, is there a big expectation from the industry?
Look, honestly, I think government is trying to nudge people towards the new taxation, to adopt the new tax policy. It is also a move towards DTC in the long run, which sooner or later will happen. Whether it happens to some extent in this budget will have to be seen. But if you ask me what is my hope and expectation, I think one of the biggest things is that the taxation for different asset classes, and sometimes within an asset class, how a particular instrument is taxed is completely different. Just taking a small example, if you hold a gold fund today, you are taxed like debt. It's completely taxed. If you hold a physical gold, right, you get indexation benefit and you pay 20% long-term capital gains tax. If you hold SGBs, which is sovereign gold bonds, you have completely tax-free returns after 8 years. Gold is gold, finally, the color doesn't change, but the taxation changes the way you kind of hold it, right? So there are multiple anomalies in multiple kind of categories or asset classes. Let's say international funds, right? International funds are finally underlying is equity in most of the cases, but they still get taxed as debt, because the clause says you have to have 65% exposure in Indian or domestic equities, right? So they don't fulfill that criteria. So these are few nuances which have never got addressed. My sense is if something happens which kind of balances out all these factors, makes the taxation a little more uniform and easy to understand across different asset classes, I think that will go a long way in simplifying investment calls for investors.
Okay, that's, I guess, a good one, and hopefully it does come through, at least in the July one, like Sonal was mentioning, you know, low expectations from this budget. Anything you expect or would hope for the debt funds?
Look, if I was on the saddle, I would completely go back 1 year back and change the clock. Honestly, I would get the indexation benefit to debt. Honestly, I think it's hard-earned money. When people park in safer instruments, they want their money to be safe. And if you can't fight inflation, which is what you're parking your money for, right, then you are actually pushing them towards riskier asset classes, which is not which ideally should not be the framework around that. You can't push investors to go into equity and forego savings. But I don't think so that will change. I think it's done for good now. One thing which I hope for is that, like you have equity linked savings scheme, which is a completely where you get ATC benefit tax advantages by investing in a 3-year locked in tax saver scheme, you should have a DLSS, which is a debt linked savings scheme, so that people who don't want to take equity risk but still want to have tax saving advantages, they should have an option correction going into a DLSS.
Okay, all right. So time will tell whether anything out of it actually comes true. But thank you so much, Mohit, for joining us today. And we've spoken about a whole host of things, investing during market correction and what we're expecting from the big event as well. So thanks a lot. And with that, we'll take your leave on this edition of MF Corner today. But you do stay tuned. Closing bell will come up to take you through the last hour of trade.